So welcome to the second video in my short series on how to pick income winners. And this series is available as part of MoneyWeek Tutorials at moneyweek.com/Tim Bennett, absolutely free. Okay. Now this is the second video in the series. In the first video, I looked at the issue of where equities fit in the world of investing. Okay. Now I want to say, right, I've chosen equities as a source of my income. What does that mean? What is income in the context of owning equities or shares? And the answer is one word: dividends. So, with no more ado, for the second email in the series, let's talk about a little bit about what dividends actually are. Okay? Well, dividends are the way that as a shareholder in a company, you extract income. Okay? Now, why do people buy shares? Well, there are about 2 or 3 reasons actually. If I buy shares in a company in the UK, for example, I might be looking for a capital gain. So I might be looking to buy low and sell high. Not so much in this series. In this series, I'm looking for income, okay? Dividends. So that's the second type of return you can get from a share. So you can get a capital gain, you can get dividends, and there's a third return. Some shares carry little perks with them. For example, one stage there were Thornton's chocolates used to give discounts on chocolate, popular with some people. Other stages, utility companies are giving discounts on utility bills and so on. I'm not so interested in that right now. So I'm going for the middle of those, income. Okay? And for beginners, for novices, dividends are the way you get income from a company. So how does that work? What does that mean? Well, first of all, there are 2 types. All right? Companies can offer something I'm not going to spend a lot of time on in this video, a preferred dividend, or they can offer an ordinary dividend. Okay, pref or an ord. That's the ordinary dividends we're going to be focusing on in this video as we hunt down our income winners. Okay, preferred dividends, that's a relatively small part of the investing world these days, but some companies will offer a fixed dividend ahead of the dividend paid to ordinary shareholders. Okay, it's fixed because it might be, say, 6% of the outstanding, what's called nominal value of those shares. All right, so in many ways, it's like the return from a bank account. But we're interested in the much bigger dividend. This is a relatively small part of most companies that even bother with dividends payouts these days. So we're interested in the ordinary dividends. Those are the much bigger payouts that matter to income investors. Okay, now who decides how much money a particular share will pay out as a dividend? The answer is the directors of that company. Okay, you as a shareholder get the chance to then vote in favour of the payment they're going to make for the year at the annual general meeting. All right, but it's the directors who determine the size of the ordinary dividend, and it's only paid out once the directors have covered other costs on behalf of the company, like interest on bank loans and overdrafts, for example. So this represents, the ordinary dividend, if you like, an allocation of the total profit figure that the company's made for the last financial year. So the way that could work is basically if a company makes profits of, let's say, 100 million sterling. All right, now profits are basically what you get for a company over, say, 12 months, one trading period, when you compare what it's sold to what it costs to make those sales. Okay, so what you've sold minus what it costs you to make those sales is profit, and the directors then make a decision. Do we keep that profit in the business and try and grow the business in future years, or do we pay it out to our shareholders? Okay, and some companies are much more generous than others, and looking for income winners, we're going to be wanting to find the companies that are reliable payers of regular dividends. All right, so the directors will sit down and say, well, maybe we choose to pay 25 million out in total in the form of dividends. We're going to hand that back to shareholders. Okay, and the exact proportion that you get of that 25 million will depend on how many of the company's ordinary shares you own. Okay, if the company is issued, for argument's sake, 100 million ordinary shares, and you happen to be lucky enough to own 10% of them, right, then you're going to get 10% of the total payout. All right, and you'll normally get it in 2 chunks. Directors of big companies typically will pay you 50% of the annual dividend at the halfway stage, the interim stage, and they'll pay you the rest once the annual general meeting's taken place, just after the end of the financial year, once they know what the previous year's profit figure actually is. Okay, so for an income investor, dividends form a vital part of the do I want to invest in this company equation, and actually for all investors, dividends play a really key role in their long-term returns. Okay? Since 1925, countless studies have shown that around half of the total return you could have got from the American S&P 500, for example, came from dividends. Anyone who's been a FTSE 100 investor over the last decade or so will know that almost the only return they've got, because share prices haven't really done much until very, very recently, has been in the form of dividends. All right? So dividends are a crucial part of investing, and if you're picking income winners, the word dividend is going to be a fairly key part of your overall strategy.